Hey guys, this is a deep dive into American battery technology company. The goal of these deep dives is to take about 30 hours of research and condense it into a 30-minute video that should give you most of the information you need to make an investment decision. I'll be keeping you up to date on their progress in my weekly news update and every quarter when they come out with their quarterly results. Let's dive in. So I'll be referring to this company by their ticker symbol ABAT or ABAT, because otherwise it's quite a mouthful. And here are 4 things that might interest you about the business. So they have 2 lines of business. They have battery recycling and then they have lithium mining. The Trump administration has fast-tracked their permitting for their lithium mining because of the strategic importance to national security of battery materials. They've only just started to show some revenue over the past 5 quarters and they're still far from being profitable. But their profit margin, their operating margin in Q2 2025 at -300%. Which means that we're still very early. This stock was part of the meme stock craze during COVID, which basically meant retail investors betting that the stock would go super high, even though there were not really fundamentals yet. And today, of course, the fundamentals are there, but you still have this crowd sort of looking at the stock, which means that every once in a while the stock goes up a lot, and we can benefit from these peaks. So the 5 things I look for when picking stocks: exponential growth potential, driven by fundamentals, so a strong business underlying the stock, championed by experts, always great when smart people are excited about the stock. I have a high risk tolerance. It might not work out for some of these companies. As long as it works out for most of them, it's fine. And I have a long time horizon. And I think with ABAT that will also be important. Quick disclaimer, this is just my opinion, not investment advice. Do your own research. So let's dive into their history a bit. Initially, they were just focused on mineral extraction. So they got incorporated in 2011 as Oro Plata Resources. In 2016, they formed a subsidiary called Lithiotech to focus on a lithium resource. And then in 2019, they did a bit of a pivot. So they went from just mineral extraction to also battery recycling. It's at this point that they changed their name to American Battery Metals Corporation. And Ryan Meltzer, the current CEO, got involved. At this point, the whole founding team and the sitting management team basically left the company, and the company really went on a new direction. In that same year, they won the BASF Battery Recycling Circularity Challenge. BASF uses these battery materials as input to their production system, and so they were looking for innovative ways of production that they could then leverage. So that's the first sort of big name partner for ABAT, which helps with their credibility. Subsequently, we'll see that they get a lot of grants from the Department of Energy, the DOE, which is something that Ryan, I think in his previous roles, had experience with, and so now it's a great source of funding to the company. So they first got this for their lithium extraction techniques. And then in 2021, during COVID, they got swooped up in the whole meme stock craze. Basically, retail investors betting the price of a stock to the moon, even though the business fundamentals are really not there. I mean, the stock is doing pretty good now. It's had some revenue in the past 5 quarters, but during 2021, the business was really small, and so a stock price of 60, where the last year it's been at around 2, is crazy. Then in 2021, they applied for a listing on the NASDAQ. They were listed before, but on a different exchange. And they started the groundbreaking on their first recycling facility, their pilot in Fernley. They changed their name in 2021 to American Battery Technology Company, still a pretty long name. And they received a grant in 2021 for their process of recycling batteries. In the summer of 21, they started drilling on their Tonopah Flats lithium project, and they established a research center. And then in 2022, they got 2 grants, both for their lithium hydroxide facility, so the plant that treats the lithium they get out of this clay ground, and their battery recycling factory. The first grant, the 57 million, was cancelled basically by the administration last Wednesday on 15th of October. They're fighting the the cancellation in court. So let's see where that ends up. But they will continue, of course, with the lithium clay ground project. And then in 2022, they got listed under the ticker ABAT on the NASDAQ. So here's the current management team. So Ryan Meltzer, the CEO and CTO, so like I mentioned, he sort of was there at the pivot at 2019. I think a bunch of interesting experience, but his most relevant experience was at Tesla, where he was at the battery material processing part, the R&D part of the plant, and basically making a battery manufacturing facility. So there he learned how to construct batteries, and he's taken that experience to define a process to deconstruct these batteries, in a nutshell. On the right, we have Scott, who is responsible for the resources part. So that's the lithium extraction part, the mining part of the company. He sits at the NNDA, the Northern Nevada Development Authority. That can't hurt, since you need a lot of approvals to start this type of mining activity. So I guess a well-connected guy with a lot of experience in the field. And then recently, a bit over a year ago, Stephen Wu joined as a chief operating officer, focused at scaling their battery recycling activities. So also quite some interesting experience, as you can see here. Then the ownership of the company. So here you see the number of shares owned by the top 10 owners, ownership percentage and what it's worth. So a bit of an interesting part, the management team that left around 2019, around that pivot, they still hold about 44% of the company. Ryan, the current CEO, holds 3%, a bit under 3%. So I'd like to see that higher. I'm sure he would too. But okay, that is the way it is. Here I made an overview of the supply chain from basically the battery material providers until the manufacturers at the end, who make the end products. So to get these battery materials, there's basically two paths. So there's the mining of the actual materials, and there's the recycling of batteries to get these materials. Basically all of this is done for the most part outside of the US. So these critical materials, the extraction really out of the ground, lithium, nickel, cobalt, and manganese are the big ones. As you can see, all of them are outside of the US mostly. And also, most of the recycling is done in China and South Korea. You see a lot of the names here. Redwood is one of the examples of a recycling company in the US. They're not listed yet, so we cannot invest in it. But most of these companies are out of the United States. American battery technology company is basically doing the two of these. So there's the mining of the lithium and the recycling of the batteries. Then when it comes to the refining, most of it again is outside of the United States, mostly in Asia. And also here ABAT plays a role. And I mentioned this US perspective is because that's one of the sort of the fires under ABAT is the fact that the US wants to have strategic autonomy on these types of technologies and resources. So this is a really sort of a call to action for the United States and a plus for ABAT. Then when it comes to cell manufacturing, again, Asia and China account for about 70% of the cell manufacturing. And then the end users who make the products are a bit everywhere. So think about the big car companies. And so, of course, this market is not static. Bain & Company estimated that the amount of electric vehicles that will be produced is going to increase by about 20% from 2023 to 2030 per year. And global battery demand will increase by 23% per year over the same period. Recently, with all the data centers for AI coming online and the importance of energy in that equation, it means probably that the steady state batteries that will be built next to these facilities to sort of regulate energy coming in and out is going to add another layer, which ABAT is going to profit from. So these figures might even be higher, which of course leads to an increase in demand for these battery materials. Because the more batteries you make, the more materials of course you need. And this is a chart for lithium for the demand outlook, but this chart basically is the same for any other material you can find. And so that brings us a bit to the pitch, the initial pitch of ABAT that they gave. So security of supply is a big one. So like we've seen, less than 1% of the battery material supply is coming from the United States. The cost is only going up, like the dynamic I've showed, with increasing battery production and the demand of the materials going up. So the cost can only go up there. And the way these materials are either extracted or recycled has a really negative environmental impact. This slide is coming from their investor deck from before Trump was elected. This one was one that was really pressed on a lot during the Biden administration. I don't see it a lot today. It's become a bit less fashionable, maybe the sustainability element, but the way they go about things is also a lot more environmentally friendly than the existing methods. So this is the picture that the company likes to use to explain their business model. They say that if you have a cost-effective recycling industry and demand for batteries would be stable, this recycling of the different waste materials in the production process, but also of the end-of-life batteries, so batteries that have been used up, that recycling would be enough to sustain the industry itself. But as we've seen, demand for batteries is growing, so it's not enough to just recycle the batteries and the waste. You also need to introduce new battery materials into the supply chain. And to do that, of course, you need to have mining activities to extract these battery materials out of the ground. And so that brings us to the two business lines of ABAT. So you have the battery recycling and the lithium mining. On the recycling end, so they have their pilot plant, a 20,000 ton per year capacity plant in Reno, and they're currently in development for their commercial scale plant. So they're thinking to build it in the southeast of the US, co-located with an original equipment manufacturer, so that will likely be an EV producer. And they have a grant from the Department of Energy of about $144 million. And then next to it, they have their lithium mining operations, so their Tonopah Flats lithium clay ground that they're also building out. So on the recycling part, they claim a few differences between them and the competition, where the competition, when recycling, mostly starts from either shredding or smelting the batteries, leading to a black mass. That's sort of a material that then gets further developed, and the battery materials are extracted from that. So what they claim is that those methods of shredding and of smelting are expensive, have a high environmental impact, and the recovery rates are not great. And so what they claim themselves is a process that they have, a two-phase process that starts with, rather than shredding or smelting, it starts with an automated demanufacturing process. So taking apart the batteries, taking them apart to get rid of the plastic, steel, copper, and aluminum parts of the battery. This process resulting in the same black mass that the other the competition's production processes would lead to, but with a higher grade. And then there's a phase two where they extract the battery materials from that black mass. And this is a very important stage. So in the pilot plant, they have this up and running, from what I can tell, but the phase two is still to be put into production. So currently they're just selling their black mass and the different components into the market, but this phase will activate really the battery materials sales, and that should be the higher value revenue also that they generate. So that's really something to look forward to. And then in terms of the sourcing, where do they get these different materials? So of course there are the automotive OEMs, so the car companies, Ford, Stellantis, General Motors. They have quite some partnerships there. They have the cell manufacturers themselves, so the BASF as mentioned before. So there's also waste products and things that they feed into American Battery Technology Company. Then on the community and consumer side, so they recently partnered with Call to Recycle as a nationwide program that will sort of feed consumer electronics batteries into ABAT. And then, as I mentioned, Another really interesting category will be steady state battery energy storage systems next to data centers. So the batteries that help regulate the energy flows into these data centers, which will also be really interesting for recycling purposes for ABAT going forward. And then there are a bunch of other industries that have end-of-life batteries and scrap that can feed into the American battery stock. So let's focus on the mining side of the business. So they definitely have a couple of tailwinds for their lithium clay ground project. So the Trump administration is really big on the importance of strategic autonomy in battery materials. They see it as a national security issue that they need to be able to produce this stuff themselves in their own country. And as we've seen, most of it is done outside of the United States. So they've fast-tracked the permitting for this field, first making them a transparency priority project, and then even turning them into a covered project, which should really boost the timeline for realizing this. They did have a grant of around $57 million from the Department of Energy that was cancelled just this week, the 15th October. They're fighting the claim or the cancellation, but let's see where that ends up. On top of that, they've received a letter of interest from the US Export-Import Bank of $900 million, a low-interest loan that they could use to develop this land. So that might be a way they're going to fund this. And just looking at the pre-feasibility study that they've done, a couple of highlights. So assuming a certain tonnage they get out of the ground per year and a lifetime of around 45 years, they see a net present value after tax of around $2.6 billion US dollars. So that's basically the value of that mine and the cash flows that it's going to generate. So for a company that's currently has a market cap of around 300 million, that could be a really big bump once this comes live. So let's have a look at the competition. This is a slide coming from ABAT themselves. The way they position themselves is that you have either recycling companies and you have pure lithium mining companies, but you don't really have the combined element, which I guess is fair. So just looking at the recycling part, you have Redwood Materials. I think this is a really interesting company operating at a different scale than ABAT. They've raised billions and they have a couple $1 billion loan from the Department of Energy. So really cool company, but it's private, so we cannot invest today. Lyseco is basically bankrupt, so let's skip that. And Ascent, again, operating at a bit higher level in terms of capital involved than ABAT, but also private, so we cannot invest in it. And then looking at the pure play lithium miners, I mean, if you want pure exposure to lithium, that might be a way to go. Not all of these guys are listed, so you cannot invest in all of them. But I think what's interesting about American battery technology company is that they don't just have exposure to pure lithium, but all these other different battery materials in the supply chain, and they play a real role in the supply chain in terms of recycling. You don't want all these batteries ending up in some type of junkyard, so there's this sort of additional added value that they bring, and this is really the underdog in the market, I would say. It's the smallest player, but it has maybe the most room to grow, and besides that, it's the only one interesting one really we can invest in. So that pleads for ABAT for me. So this is a really interesting part to the ABAT story. Not super fundamental, but it is an effect that we see in the stock market. So during COVID, we had what was called the meme stock craze. So what happened there is that there were certain businesses, for example, GameStop, maybe there were hedge funds that were shorting these stocks, so betting that the stocks would go down. And then you had this whole retail investor group that saw that and saw an opportunity to really make the price of these shares go up by betting on this company. And so you've seen a lot of these companies with really not great fundamental businesses going to sky high stock prices just because these retail investors kept buying and buying and buying and pushing the stock up further. And so hedge funds that were shorting those stocks got squeezed because they make money when the stock goes down, but they have basically infinite losses when the stock price goes up. And so that puts additional pressure, upward pressure on the stocks. And so American Battery Technology Company was one of these stocks that was treated that way. And so at some point they got to a valuation a stock price rather of around $60 per share. Which, given their business at the time, I mean, they've been making money for the past 5 quarters. Back then, there was really none of that going on, so the price was completely ridiculous. But the interesting part of that is that I feel that this group of retail investors is still sort of attached to the stock, and so what you see periodically is that the stock, when there is some good news and there is some momentum building, you see that the stock goes up a lot faster than maybe it should. Which is interesting because then you can take advantage of those opportunities to sell, make a big profit, and then buy again once it drops back down to a bit more normal levels. So just an interesting element to the stock. So let's dive into their financials a little bit. In this first chart, I show the last 5 quarters, and I show their revenue and their cost. So the last 5 quarters, because they started making revenue 5 quarters ago. You see that their revenue is starting to ramp. So 2.8 million in Q2 of 2025. And here in red, you see the cost of goods sold and the operating expenses. So these costs of goods sold, they're ramping as they're scaling up production. So they're hiring more people to ramp up to a 24/7 production. And the depreciation costs, of course, for the factory are starting up as they're starting up their operations. Of course, they will need to get up and running and get the efficiencies before this cost will be a normal range in terms of costs as a percentage of revenue. Above that, in the green line, you see the operating expenses. We'll go into a bit what is in those costs, but what is interesting to see is when you add the cost of goods sold and the OPEX together, you see that it is decreasing whilst revenue is scaling. So at least that is the right trend. You want revenue to go up and costs at least not to go up as fast. Going down is even better to reach profitability at some point. Just for reference, there was an impairment hit related to a building and the sale of land that I didn't include here to not model the picture. And so as they state in their 10K quarterly report that they expect the cost to reduce as a percentage of revenue as they scale operations and gain efficiencies. So then moving on to a further breakdown of operation expenses, OPEX. So they divide into 3 categories, general and administrative costs, R&D costs, and exploration costs. What you see here is basically a shift of costs from one bucket to the next. As they start to scale their operations, they're moving people from R&D cost to cost of goods sold, and people to more general and administrative. And at the same time, their mining activities are really advancing, and so a lot of people that were in the exploration part of the costs are now moving also to other types of activities. And so the good thing is that, as we've seen here, is that there are these shifts. Things are moving left to right within OPEX and towards cost of goods sold, but the total is decreasing. So that's good to see. And then, like they said, they're expecting to gain in efficiency as they ramp. And those cost decreases and revenue increases are leading to margin improvement. So in red you see the operating margin, and in blue the gross margin. So gross margin is basically revenue minus cost of goods sold. And if you then also subtract the operating expenses, you get to the red line. And okay, it's a minus 100% in gross margin and a minus 300% in operating margin. This is something we need to track quarter over quarter to see that this is moving in the right direction. And of course, so this is just a pilot plant of battery recycling that's adding here. It doesn't include yet the second stage of their recycling, as we talked about, which really extracts the more higher value battery materials. And it doesn't include the commercial scale plant. And it also doesn't include yet the lithium mine. So really just coming from the pilot plant here. But they have stated that they think it can be cash flow positive in itself. So let's see where they end up in the coming quarters. So let's have a look at their balance sheet. So they have about 12.5 million of cash and restricted cash to fund their business. 5 million restricted cash is related to the note they have of almost $8 million. So not a lot of cash and also not a lot of debt, but certainly something needs to happen here, because if we look at their cash flow statement, their operations, the cash flows from operating activities is a negative 29 million in 2025, the full year. So they're burning through around 29 million per year, which they need to fund somehow. And with 12.5 million in cash, or actually 7.5 million in cash that they can just use, they will need to do something to fund those operations. And so one of them is getting on more debt, but also they could raise new shares. So if you look here at this chart, it shows in blue the number of shares that are outstanding. And you see that since the beginning of 2024, more or less, they've been adding to the shares outstanding, adding about, I guess, an average of 10-12% of shares per year. So they give out shares for which they get money back to fund their operations. And so they have this ATM at the market sale agreement with Virtu Americas, which allows them to sell their stocks to the market whenever they see fit. So they would do that probably when the market, when the price goes up, when the stock price is high. So I hope they did that at the 14th of October when the stock reached 11.3%. And here again, that whole meme stock thing is coming through, because it went to 11.3 based on a bit of mania, in my opinion. I mean, I think on the Tuesday or on the Monday, they came out with news that they handed in all the studies for their lithium clay ground. So they did their homework, and then the stock shot up by 30%. So to me, that's a bit of exuberance. So yeah, that's about the credit facility. So we'll see in the next quarter if they improve their cash position by offering new shares. And so finally, besides the means that they currently have on their balance sheet, they have a lot of grants and subsidies that they were awarded, really in the hundreds of millions, both for their recycling operations and for building this new commercial scale plant of 100,000 tons per year, as well as developing their lithium clay ground. So a few hundred million in grants. The way it's usually set up is that they get a 100 million grant, which means that they need to put in 50 million and the government will pay for the additional 50 million. So like I said, for the lithium clay ground, they did, the government cancelled their grant of 57 million. So that was a bit of a painful one. So let's see if they get that back when they go to court over it. So this is another set of funding for their business, but they will have to put the additional cash up themselves, the other 50%. So they will need to fund that business somehow. And so let's end a bit on a summary of the risks involved. I would like to see a bit more high-profile investors and other types of characters championing the stock and the company. I think that would be good to get a bit more exposure. The ownership is mostly ex-management team, like we've seen, about 44%, and the CEO holds a bit less than 3%. I don't really know where the allegiance of that ex-management team lies, how long-term their vision is, so we need to see about that. The CEO is primarily and first and foremost like a scientist, and the question is a bit, can he drive this commercialization that the company needs to go through? I guess so far so good, so let's see how he does. They have a big focus on grants and subsidies. These take time to get. You need to fulfill a lot of requirements, and they are uncertain, like we've seen with the grant getting cancelled. But it also leads to a lot of connections and tailwinds from the administration, so I guess it can also be a good thing. Their burn rate is around 30 million, and they have 7.5 million in cash if you subtract the restricted cash. So something needs to happen there, probably share issuance. It's a very early stage. Like I said, the revenue is basically coming from half of the pilot plant. They have a lot more business that they need to bring online. So a lot can still go wrong in theory. And their time horizon for operations to scale is, in my estimate, about 3 to 5 years. First of all, getting the pilot plant to go from phase 1 to phase 1 and phase 2 of the recycling. There's the commercial plant they need to bring online. There's the lithium playground that they need to get online, which will probably take about 3 to 4 years. So all in all, quite a long time horizon. But I think all of these things mean that we are very early. The stock has gone a bit nuts in the past weeks, but I mean, I've been holding this for about a year, and I bought in at, I think, €1 or $1. It's currently trading at about 6. It's been at 11. So there's a lot of room for growth, and I think if this company really realizes their potential, this stock can go really high. So I think a lot of risks, but the return is there too. Given that we're quite early on, and I think the market hasn't really picked up on the stock yet. So overall, I think it's a super exciting stock. Let me know what you think about it and what you want to see next. Thank you for sticking around, and I'll see you next time.